Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and we've seen a bit of market volatility here yesterday. So today we're going to spend a little bit of time reviewing the sell-off that we saw yesterday, have a better understanding as to where that was contained within, and think a little bit about how we can position ourselves going forward. So let's go ahead and get started. But before we do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So we'll start off as we normally do with a broader market update to see where the broad-based indices currently sit. As we'll see during that segment, there is a fair amount of isolation in terms of the sell-off. So we do also want to take a look at how the rates market, meaning the fixed income markets, have impacted the current equity rally that we have been in for the past few months. Some of the commodities that have started to move as a result of this, and most importantly, the sector rotation data that we're currently seeing, because the sell-off has been fairly contained to just largely one sector. And the other sectors have actually seen quite a bit of strong rotation into those sectors. And that really provides quite a bit of insight for us in terms of how do we position for this and answering the question as to whether this is part of a bigger sell-off. And lastly, we'll share with you a few ideas before we open this up for Q&A. But the primary question that I want to help investors answer here today, which is something that we started to receive quite a bit of over the past day, is, are we watching the start of a larger correction here, or is just simply the markets bleeding off some momentum and perhaps continuing an equity rally going forward? That's the primary question. So my name is Tony Zhang. I'm the chief strategist here at Options Play. And I want to share with you my charts, my technical research, and how I'm using it to inform my decisions to position here for the current equity market. So we'll start off with the broader markets with the S&P 500. And if we look at the sell-off in the context of the S&P 500 yesterday, we really haven't pulled back very far. We pulled back pretty much to the 21-day moving average. And so far, as of yesterday's close, we held that level. Looks like today we're about to open up a little bit below that level, but largely not a whole lot of downside, if you will, here for the S&P 500. There is this support level here that looks like we're going to break below this level here on today's open. We have some support here below in the 370 range or so. That could be potentially a short-term target here to the downside as if we start to see more of an acceleration. But largely, yesterday's sell-off was contained to technology shares or technology stocks. So if we look at the NASDAQ 100 index, which has been on a pretty strong trajectory to the upside, we saw a break below the 21-day moving average. We saw a break below this uptrend, which certainly points us potentially down to this 303 support level, which goes back to the September 2nd highs. Those are some of the levels we're paying attention to here on the technology side of things. And especially if you look at the sell-off yesterday, it was largely in stocks that were contained either in unprofitable stocks, unprofitable tech stocks, or tech stocks that did very well during the pandemic or during lockdowns, such as Peloton, quite a bit of solar stocks. Those types of stocks were the ones that sold off heavily. So especially over the past few weeks and largely even the last few months, a lot of investors have been concerned about excess in the market. Investors have been concerned about rich valuations across the board. And what we're really seeing is a bleed off of some of that excess and a bleed off of some of that momentum and rich valuations. We're seeing them in fairly quick sell-offs and corrections here. But again, that sell-off is fairly contained because if we look at small caps, Russell 2000 yesterday was actually up on the day while the major indices were down on the day. So the Russell 2000 remains by far the strongest of the major indices. And despite yesterday's sell-off, continues to be strong. So small caps holding those levels. We're not seeing a broad-based sell-off here. It's only contained in certain higher growth higher beta stocks that have been trading at extremely rich valuations that investors have been concerned about. And that, for me, is actually a good thing. When we're able to bleed off some of that momentum, when we're able to remove some of that excess, that provides the opportunity for markets to then continue moving higher. The further we have that excess, the more concerned investors become with the broader equity rally. So seeing yesterday's price action, in my opinion, is actually more constructive for equity markets to continue higher in 2021, especially if you look at the RSP, S&P 500 equal weight index, also making a new high yesterday, making a new all-time high, while tech stocks were selling off fairly heavily yesterday. So this type of rotation, again, in my opinion, is relatively healthy for a market rally that has been somewhat overextended here over the past couple of months. Now, we've talked about value versus growth. So on the left hand, this is a weekly chart on the left-hand side. We continue to see value underperform growth for a long period of time, multiple years, and we've talked about this bottoming formation that has started to form here over the last 6 months, meaning value is no longer underperforming growth. And this is a zoomed in chart here on the right-hand side. This is that same 6-month bottoming formation. And for those of you that are chartists, this looks somewhat like an inverted head and shoulders, which is in a reversal pattern. So when you see a downtrend, a reversal pattern like a head and shoulders, that implies a potential break to the upside. And despite failing to break this level here about a month ago, we're back at these levels again, where value potentially has the opportunity of breaking out and replaying or playing some catch up here with growth. Now, just to be clear, we have not broken out yet, meaning this inverted head and shoulders has not been completed yet and has not broken the neckline yet. There is still the possibility that this just continues to move back towards growth. And that is one metric that we're paying attention to, because if we do get this breakout here to the upside, that starts to put value into a rotation into value that we need to start thinking about, because this is a multi-year correction here in terms of value versus growth. So this is one that we're paying attention to. We haven't had the breakout yet, but this is one that has been on our radar for a couple of months now. Now, when we turn our attention here to emerging markets has sold off fairly heavily here yesterday as well. But just to put again into context, the sell-off is just a little bit below the 21-day moving average. We've seen multiple cases of this where moves below the 21-day moving average are followed by relatively strong rallies. And at the moment, this still remains our thesis until we see otherwise, that EEM, especially with a weaker dollar, emerging markets will remain a fairly strong contender here for international equities. So emerging markets so far still fairly strong, but the weakness that we've started to see here from equities is largely driven by the rise in inflation expectations. That's caused a pretty substantial rise in yields as well. We've talked about this last week. We had the breakout above 100 basis points at the beginning of the year, pull back to that 100 basis points, and a very big move here to the upside. We're currently trading at about 136 basis points on the 10-year, which, if you put that into the context of the multi-year move to the downside on yields, we went from about 325 basis points to about 50 basis points in the span about a year and a half. We've now retraced almost 38.2%, the 38.2 fib level, which corresponds to about 155 basis points. So we're still about 25 basis points away from that target, in my opinion. So we still have a little bit of upside, minimum to about 155, potentially as high as 187, but I do think that 155 will likely be a solid amount of resistance here for the 10-year yield, especially when we look at TLT. TLT rallied from about 111 back here in late 2018 all the way up to 171, and so far we've retraced exactly 50% of that move. We just hit that level yesterday. 141.59 would be the 50% retracement level. So TLT hitting some support levels. There's one more support level here around 134. In my opinion, that could be a final target. That would take us down to about, up to about 155, 150 basis points on the 10-year yield. And those are, when we see Treasury yields rise to this degree, it provides quite a few changes to our equity outlook. One, when yields are substantially higher, it makes the S&P 500 dividend yield look far less attractive, which means that equities look more expensive, especially when we look at equities based on traditional valuation metrics like PE ratio, price to book, price to sales. All of these valuation metrics are extremely stretched and trading near all-time highs, near levels that we have not seen since 2000. And the only metric where equities looked cheap was with respect to the dividend yield compared to 10-year yields, meaning equities were yielding substantially higher yield than government bonds. And when treasuries are yielding substantially higher yields than treasury bonds, then you have what is arguably a strong reason to be long equities, because you're getting substantially more yield for not substantially more volatility. But now that the yields on the 10-year and the yields on the S&P 500 are getting closer and closer together, then that really puts the two in far greater comparison, where one has far less volatility and roughly the same amount of yield. That again puts equities into a space where it's just simply not as attractive, especially when you then start looking at all of the other valuations. And that's part of the pause that we're currently seeing in the equity rally. And as treasury yields continue to climb, it's going to put a damper and put a cap on how much higher equities as an asset class can continue to rally at. And we're less likely, in my opinion, to see the same type of momentum from growth stocks in this type of higher yielding environment than we have seen over the past few years, and specifically the past year or so. So those are some of the things, the major developments that we're starting to see. And the one thing I want to point out here is also, as traders have been selling government bonds, TLT 20-year bonds, meaning safer fixed income assets, traditionally you would see an inverse correlation with higher yielding, meaning riskier fixed income products. But over the past few days, we have started to see both high yield and TLT sell off at the same time. This is a little concerning to me, but again, the sell-off in HYG is relatively minor that we've seen so far. But if this starts to accelerate, this certainly puts some concern for me in terms of the fact that we're seeing a sell-off across the risk spectrum here in fixed income products. So those are some of the developments that we're paying attention to. But the one thing that has shifted quite a bit here is gold. A lot of investors have been asking, how is it possible for gold to continue moving lower while the dollar has been moving lower? Gold is priced in dollars, and as the dollar weakens, how come the price of gold continues to tumble? And that's a great question. And to be perfectly honest, I don't think a lot of investors truly have a good answer for it, other than the fact that investors that are interested in short the dollar seem to have found better trades to make. Long other metals, long Bitcoin, long growth stocks, they just seem to have a bigger interest in some of those than gold. Gold has not provided the safe haven returns that many investors traditionally think of gold as a defensive asset. It just simply hasn't provided that at all. Certainly also doesn't provide any yield. So as yields climb, gold becomes less attractive. But we seem to have found a little bit of support here around 166 here for gold finally. And the question is really, where does gold go going forward? I think you're more likely to see some sideways price action here for gold and see if 166 holds. If we do get a break below 166, that certainly starts to put gold into into the 160 and potentially lower range. But what you start to have here is what looks like a triangle formation. And the question is which direction does that triangle break out from? So this is one to watch out for. We are reaching an apex. It can break out in one direction or another. And I think we're pretty close to getting a resolution on this sideways action that we've seen in gold for quite a few months. So turning our attention back to the dollar, this is the dollar, the weekly chart on the dollar. As you can see, the 21-week moving average has been consistently a very strong resistance level here. And a few weeks ago, we basically had the exact same thing. A breakout would look like it was going to start a reversal pattern here for dollar, where we had a inverted head and shoulders. It started to break the neckline for just one trading day before it failed and continued to move back into this consolidation range. And what that leads us to believe is that this is more likely just a consolidation range after a long period of underperformance. You have a period of equilibrium, and it has to resolve itself in one way or another. And it's looking more and more likely that the dollar will continue moving lower. We haven't broken this consolidation range yet, but this is one that we're paying attention to because as the dollar continues to move lower, assets that are priced in dollars will continue to rise. So whether we're looking at metals, we've seen a pretty big influx into metals here over the past, even yesterday, XME, the metals and mining ETF, saw substantial inflows. That ETF is tied very closely to inflation expectations. So as dollar continues to move lower, assets like Bitcoin, like gold, like silver, like metals, emerging markets, copper, all of these things that are priced in US dollars or have a tie to the US dollar will likely to continue moving higher here, especially if the Fed continues on its path of remaining accommodative from a monetary policy perspective. These are the trends that continue to perpetuate in the broader markets here. So the one thing I want to take a look at here is the sector rotation, because like I said, the sell-off here yesterday was quite unusual from the perspective is that it was very contained to one segment of the market, which is largely technology shares. It was largely unprofitable technology stocks that led the sell-off here yesterday. And that is largely where I think a lot of investors were concerned about excess and froth and rich valuations in the broader markets. And we really saw that come to a head, if you will, and investors sold off very heavily in many of those stocks. As certainly some lockdown stocks like Peloton was dragged as part of that that move, but you saw a lot of solar stocks that were arguably trading at some of the richest valuations in the market. Some semiconductor stocks also trading at fairly rich valuations. Those were the stocks that pulled back, but there were plenty of sectors where we saw rotation into as a result of that. The first one, materials. Materials, after breaking below the 21-day moving average, finally crossing back above it, starting to grind its way higher towards its all-time highs around 78. So this rotation into materials leads us to believe that this is not a broader market sell-off where you would generally see materials, industrials, consumer staples be participants in that sell-off. Instead, what we saw is strength in sectors that are part of an economic recovery. XLB, materials, these are the types of sectors that tend to outperform in the beginning of an economic recovery. We're seeing that here in materials. XLF, we've talked about XLF. This is two parts. You have the economic recovery trade, which generally speaking favors sectors like financials, and then you add on the higher yield, you add on the steepening rate curve. XLF recently breaking out above that 31.5 all-time high, and continuing to move higher here. Yesterday up almost 1% as technology shares took a huge tumble yesterday. So when you see this type of rotation, that's healthy for a market rally. You need to bleed off excess and momentum and have that flow back into weaker sectors that are part of the economic recovery. So when I see this type of rotation, that leads me to be less fearful of the sell-offs that we saw yesterday and see them as potential opportunities to buy. Now, I don't necessarily know that the sell-off was contained to just one day sell-off yesterday. I think it's very likely that we could see more weakness today, potentially even a little bit more weakness for the rest of the week. But largely, as of right now, based on the data that we have here this morning, I still believe that the rotation that we're seeing from the different sectors is relatively healthy. You see energy continuing to move higher. Energy obviously has some impact from what we're currently seeing, or the storm in Texas, limiting supply here in XLE, or oil production and refinery production. So this really targets, this $54 level here to the upside, currently at about 48 or so. XLE, the one thing I will say is that on subsequent moves higher here, the last two moves higher have not been confirmed by momentum. We're actually starting to see some exhaustion, some divergence between price making new higher highs and momentum no longer confirming those new highs. That's exactly what we've been seeing in equities and broad-based S&P QQQ for the past few months. We're seeing this emerge now in energy stocks. So this puts us into energy as the strongest sector in the market right now, on our radar of potentially seeing some divergence, starting to see some exhaustion, and perhaps seeing a pullback here in energy. So that's one I want to put on your radar. That is the strongest sector of all the sectors right now, but could potentially start to see some rotation out of energy, especially as some of the supply constraints out of Texas starts to ease. You could perhaps see a bit of a tumble here in energy, because crude prices, even though continuing to increase, I think that we're starting to see some topping, if you will, in energy prices and crude. Another sector that I want to pay attention to that has seen a very, I would say, stealth rotation is consumer staples. Over the past few weeks, consumer staples has seen quite a bit of strength here, and yesterday up up on the day, while slightly up on the day, while the broader equity markets sold off here. So consumer staples, while still one of the weaker sectors out of the major sectors, so far holding these levels here, these support levels, and kind of in this no man's land, but holding its own so far. So staples, a little deceptive rally here, a little stealth rally that we're starting to see. We're also seeing that same kind of stealth rally out of healthcare, but staples holding its own so far. Again, part of the narrative that during an economic recovery, staples, these types of stocks, will hold their own, and so far staples doing that exactly. And then if you look at industrials, similar to materials, new all-time highs yesterday while tech shares sold off heavily. This is, again, part of the in my opinion, the reason why I don't believe that we are part of this larger sell-off here in equities that we're just starting to see the start of, because we've been talking about excess, we've been talking about exhaustion, we've been talking about overbought conditions in equities, and you see the sell-off yesterday, you might be inclined to think we are starting the sell-off now. And it's perfectly reasonable to think that. But then again, when you look at the data of the underlying sectors, you see the rotation into materials, into industrials, into financials. That leads me to believe that this is not part of a broad-based sell-off. Now, things could change, right? Things could change by next week, where we start to see materials and industrials and financial sell-off as well. And when we see that, that can provide us the evidence that, okay, the market has perhaps reached the top, or maybe due for another 5 to 10% correction, perhaps even more. But the data so far does not show that, when industrials makes a new all-time high while tech shares bleed off some of that momentum. So with that, let's take a look at some of the trades here, or some of the ideas that we have. So, Microsoft recently broke out to new all-time highs above this 235 level. This is roughly 230 actually, which was the September 2nd high. It broke out and held on to these levels, but just really slowly grinded its way up and finally bled off some of that momentum here yesterday. Now, I think Microsoft is representative of a fairly large technology group that has had similar price action here. So it's pulled back to this 230 support level here. I do think that, especially if we see a little bit more weakness today from technology shares, that it could pull back even further here into this 225 level or so. But this is really, less so about an opportunity in Microsoft and more of a lesson in looking at the stocks that have sold off here in the past few weeks and identifying stocks that are profitable, identifying stocks that perhaps are selling off a little more than they should or just being caught in the crossfire here. Microsoft is an example of this. Apple potentially also another example of this. Apple trading at richer valuations, so selling off a little bit more than Microsoft. But a lot of these companies are large, profitable companies that are being caught in the crossfire here. And there are plenty of weak stocks that are unprofitable that I don't think is a buying opportunity, but I do also at the same time think there are a few diamonds in the rough that are being caught in the crossfire. And over the next few trading days, especially if we see an acceleration to the downside today and tomorrow, perhaps they become buying opportunities for some tech stocks. And Microsoft, again, I'm just using that as an example to show you a hugely profitable company that is being caught in the sell-off right now, that if you weren't comfortable buying at all-time highs, waiting for a pullback into some strong support here like 225, the 225 level could be an opportunity to pick up this stock at a slightly lower price and look for a better risk-reward ratio on a move to the upside rather than buying at all-time highs. And then I want to take a look at travel stocks like Southwest Airlines, breaking out higher here. And despite the weakness we've seen over the past few weeks, travel stocks continue to be strong here. LUV, Southwest Airlines, I think has a shot of getting back up to this $58, $59 level, which has been all-time resistance for quite some time, and potentially has the opportunity of reaching that level and potentially moving higher. And there are a lot of stocks, I think, in this particular type of trade as well within the travel community. And lastly, financials, Morgan Stanley trading near a double top here. Also, a lot of banks in similar positions. As you can see, yields are reaching new all-time highs. These stocks have not reached new all-time highs and are at this double top potential breakout here. So looking for some opportunities in some financials also are the places that I would look in this current market environment. So that's how I'm viewing the broader markets here at the moment. Like I said, yesterday's sell-off was a little concerning for some investors, especially if you held some of those growth stocks. You saw 5, 7, 10% declines in some of these stocks in a single day. And it's perfectly reasonable to see that type of price action and be a little concerned and can be concerned, especially as a lot of participants have been talking about excess and froth in the markets. This is bleeding off some of that froth. The rest of the market has not followed through on that. If anything, the rest of the market has actually breathed a sigh of relief, if you will, from that, and has continued to move higher. And that's where I think you should be looking for opportunities. And then even within the tech sector, I do think over the next few days, you might find some better opportunities to get long some of those stocks. So with that, that gives you an idea as far as how I'm currently viewing the market. I hope that this is helpful in giving you a good start for your day and your week. And just to do a little bit of housekeeping here, I'm not here next week, but I will be back here the following week on March 9th. So with that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here in 2 weeks' time.